Red, 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 red. Okay, ready? No?
Oh, I just imagined Will or Ian editing the podcast and taking that soundbite right there, going,
Yep. Either that's right in the trash or right to the beginning. Hello, everybody. My name is Miles Clark. I'm joined here with David Clark.
pleasure as always.
Yeah, it is nice to have you in the office. Whenever you come in, we make sure to get you on the pod. So you're stuck.
Yeah, I found out yesterday without even knowing that I was doing a podcast today. And it was just sort of, I think you were in passing conversation with somebody and you mentioned that you and I were doing a podcast. And I was like, oh, that's news to me. But hey,
Yeah.
I'm glad to get on here.
You
Yeah.
know, Clark Brothers, I think it's part two or maybe part three. I don't know.
We may be at part 3 at this point.
Well,
But anyways, we've
we'll
still
see.
got a lot to talk about today.
We do, yeah. In terms of a performance perspective, it is a pretty mostly red week across the board. S&P 500 falling about a percentage point towards the downside since last Wednesday. Russell 2000, so small caps down there towards the bottom of the pack, falling about 2.5% over the last 7 days. Names in positive territory, gold, right? We can mention that as a maybe,
Immensely.
yeah,
Yeah, it's done well in the past month.
yeah, and there's plenty to talk about there for sure. The US dollar and crude oil also, those are the only three names of the names we typically look at that are landing in the green. So some commodities and the greenback.
Yeah, it's been interesting, especially with sort of the commodities piece, but we'll talk about some of that as later in the podcast because we want to zero our focus in today on sort of a update piece that we have put together that we're trying to sort of get the word out there on. So I'll let you take it from there on what it is we're getting out.
Yeah, sure. So what we put together as a team is what we have named appropriately the weight of the evidence, right? That is, as a prudent asset manager, are always trying to create this weight of the evidence type of argument when you're entering into or exiting positions in different asset classes for that tactical rotation idea. So that was a lot of gibberish, but the point is we put together a pretty high level quarterly report, again, called the weight of the evidence. That's on the platform. And we're going to be pushing it out on social media and some other kind of avenues as well. So if you're on the platform, it's been listed in the Were You Awares in the daily equity report. We're talking about it. We'll throw it down in the description as well. So if you're listening to that there as well, just go ahead and read on it. And be high level.
Part of our biggest well, and that's part of our biggest push with it is typically, and often to sort of our own fault in some fashion that we tend to get very wrapped up in our own jargon,
Yeah.
especially because we're really talking to a lot of our clients. We sort of have our own lingo. This is meant to be very much a non-DW user friendly
Yeah.
type of situation where if someone's new to Dorsey Wright, this is a segue where you can understand how we're viewing the market, what we're viewing,
Yeah.
sort of what we're looking for, so on and so forth.
Whether you know 20% of Dorsey Wright stuff, whether you know 80%, whether you know nothing, whether you know
Yeah.
at all, this
Whether
is
you're a
supposed to
one-time
be
client
there.
or you've been around since 87.
Right,
Either way,
exactly.
it should be readable.
And it's been approved from our side, from a compliance perspective, for both non-professional users and finance professional users as well. Of course, if you are a financial professional that's going to be distributing out or using any part of it with conversation with clients, of course, go through your own compliance as well. So that should be noted. But from our side of things, it's aimed towards, the whole group.
And much of this is sort of more shorter pieces that are meant to be quick talking points.
Yeah.
Not so much, I mean, it is a 20-page document, but it's mostly 18 short, teeny tiny articles is
Right.
really the
Yes.
way I look at it.
Yes, yeah. So easy to split up. And talking about talking points, I think the best talking point for at least the first quarter has been drumroll momentum, right? Yeah. So it's designed to be somewhat familiar, right? When we put out in future quarters, familiar, sector leadership, domestic equity leadership, but also with some kind of featured highlights, if you will. So a couple of the featured highlights for the first quarter of 2024 was the historically strong core, which we'll probably reference over the course of the pod today. And then two, focused momentum has been doing really, really well. And there's a couple different studies that we haven't brought up necessarily in the report so far But we did bring up in the quarterly deal that I think is worth mentioning, and that has to do with the performance for proxy MTUM. So MTUM is a proxy for momentum, has been doing really well so far in 2024.
And it was sort of what the study's looking at here is historically, when it does have a positive Q1, it tends to have decent follow through
Correct.
in those years in the following 9 months. So
yeah, fingers crossed, right? I mean, but if I were to tell you that coming off of 2023, let's just start with this. I tell you in 2023, Momentum's worst first quarter ever, right? But going back to its whole history, Momentum had a pretty rough year last year. If I were to tell you, David, you think that the first quarter of 2024 is going to be MTUM's best first quarter ever? Would you believe me?
I mean, in almost some fashion, because it was the worst last year, it's kind of just ironic that it's the best this year, but hindsight 2020.
Yeah.
No.
Yeah.
Yeah. I'm not gonna say but
Right.
yeah, anticipate January 2024 to be really rock or for Q1 2024 to be really rocking and rolling for Momentum, especially with the experience last year. I mean, you know, we towards the end of 23 had started to settle into our leadership. So that's where we really when we really felt, okay, this is when we think we can start capturing some of this. And we've seen some of that come to fruition with through 2024. Now we're looking at some of that same, hoping some of that same leadership obviously continues into Q2.
Right. Yeah. And just one of the statistics, actually just reading it straight from the sheet itself, of the 21 times in which MTUM outperformed the broad market in the first quarter, 16 of those instances were followed with additional outperformance during the last 9 months of the year, right? That's over 75% of the time, right? So there's still that other 25% of the time. We won't talk about that. But at least historically speaking, it looks like the, productive first quarter for Momentum is a productive full year for Momentum.
Well, and what's interesting too that's pointed out here is that the Q2 average return following these periods of positive, for Q1s for MTUM has been about 4%, at least in that last little bit there, so again, hopefully we maintain this leadership. I mean, right now, what's kind of interesting and sort of maybe segues into another piece there about sectors is we still see tech leadership, which is good news for us because it's been able to maintain there along with other sectors. I mean, industrials, cyclicals included in that conversation.
You're leaving out one. You're leaving out one.
In this case, for the sector seasonality piece, and communication services.
Yes, I mean, that's. I think a lot of people would say that's pretty much tech, right?
Depending on who you're looking at,
But they were actually, again, they were one of the better. They were the best performer of those Spider Select funds for the first quarter. They were up about 13% through the first quarter. Pretty good.
Yeah, and that's sort of maybe its own podcast of under the hood of some ETFs, what you're looking at, but. Before we digress.
Yes. Sorry, I can get us off topic super easily, but sector leadership, right? You're seeing prolonged strength from industrials and technology, and that is when Momentum is really going to kick, right? It's really going to say, hey, when you have these guys that are really strong, you can allow Momentum to overweight those groups as much as possible, and then kind of the same way towards the downside, right? You have utilities, you have, real estate, you have consumer staples, these risk off assets, if you will. These guys have been kind of sucky, for lack of a better word, for quite a while. And there's been little laggard bounces in there, like healthcare is one of them, that you get some upside participation for. But for the most part, you've seen your prolonged leadership and your prolonged, weakness that's really kind of built for momentum-based strategies, which is, again, why we're seeing that so far in 2024.
Yeah, and even kind of looking into Q2 at some of the sector seasonality that's featured in the report, it's at least kind of, giving us some additional fodder for really, again, stacking the weight, the evidence that, all right, what might we anticipate? I mean, one of the interesting things to me about looking at sort of a sector seasonality piece is, coming off of this quarter, XLC was the top performer. Communications tends to have a fairly decent Q2. And so that's one thing we'll obviously keep an eye on, but so does technology. I mean, and currently our number one ranked sector. So again, a lot of these, what I think's the big point we're trying to drive home with this update and sort of the articles that we're featuring and talking about is that this provides you quick touch points,
Yeah.
quick talking points as well, to even bring up some of the old anecdotes that we might even talk about as
Right.
well. So, it's all meant to drive a conversation potentially between you and client, or honestly, for somebody who's a new user to Dorsey Wright, you can segue that into how you view the market.
Yeah.
You may not have our entire jargon, but that's what we're trying to do here. We're trying to say, hey, here's some of the research that we do that's a little more high level, a little more easy to sort of consume, if you will. You don't have to have a secondary dictionary of our own
Right.
lingo.
Yeah, the whole glossary, if you will. And I'll kind of just zoom out for a second and say, if you kind of are listening and you have, you look through it, leave us, some feedback in the comments or give us a call. Our line is just, you can just Google Dorsey Wright and give us a phone call. We want to hear, we write this content, so it's useful. Yes, it's fun for us to do. We enjoy it. But at the same time, we write it for you all as listeners and as people who are using our content to communicate with clients. So at the end of the day, if you're seeing something that isn't in there that you want to hear in there, or an idea for a future quarter or something like that, let us know, and we'll do our best to listen to that in the future.
Yeah, and well, we'll sort of use that as a segue point to sort of come back to talking about some things this week that we're seeing going on. Because one of the articles that's in there talks about the bullish percent for the NYSE, but one of the things that we have seen transpire this week is the bullish percent for SPX is reversed down. Yes.
Now, here's the kind of silver lining, right? I mean, you don't ever like to see reversals, but historically speaking, reversals from high field positioning are more often than not, I'm going to kind of be careful with my words here, are more often than not strong markets taking a breather rather than the one. If you think about a big tsunami, right? Most of the time, it's not the big tsunami. When it is, it's bad. But most of the time, those reversals are relax, and then an upside in participation.
Well, and that's a lot of times why we put sort of those levels of demarcation.
Right.
In terms of, and granted, we saw the BP sort of fall below that 70% mark, but I mean, that's still pretty elevated, all things considered.
Right. Yeah.
And really, for us, whenever we start to get worried from a participation standpoint, is that all important 50% mark?
Yeah.
Suggesting that then less than half of the stocks out there in a particular universe are trading on point and figure buy signals have low participation. At this point, though, not happening. Right now, we've just seen an initial reversal. I mean, with yesterday's hotter than anticipated inflation print,
Right.
we had quite a few things happen in terms of chart action. The BP SPX reversing down there at 64% is just one of them.
Yeah, what I'm concerned about is us as analysts, and I think really just everybody probably subconsciously has been saying, okay, Nvidia's gone up. I was about to say Apple. Apple hasn't gone up. But you've had those concentrated market leaders bring you higher, right? And so we've been looking for other pockets. We've mentioned equal weighted assets. We've mentioned small caps. Those guys have been doing well, but a higher for longer rate environment probably isn't great for small cap names, right? Because they're pretty capital intensive. So a higher, they're borrowing at a higher rate, then that's an issue. So you see the Russell 2000, I mentioned it at the beginning of the podcast, is one of those guys that are the biggest losers for the last week. TNX climbing higher. You're getting, hopes or maybe some tampered expectations for rate cuts so far in 2024. Yeah, I mean,
it's not, it's sort of almost that the conversation around potential rate cuts from the Fed is coming to a head.
Right.
It truly is coming to the time of, for the lack of a better phrase, put up or shut up.
Yep,
are we going to do it? I had another one, but I didn't think it appropriate for a podcast.
Well, yeah, we'll
keep that one between. I'll tell you that one afterwards. But anyways, it's sort of coming to the point of, all right, we either got to do it or we're not going to do it. And in a lot of fashions, especially with the inflation print this week and even jobs data last week, you're kind of seeing this narrative that, all right, we might just kind of sit tight for a minute.
Right.
Almost kind of we're going to sit on our hands till something really happens to make us pull our hands out again.
Right, right. And as much as I want to see like I want to say 4 consecutive buy signals for RUT. We'll throw it up on the chart.
Yeah.
Nice stair-stepping pattern. But when I write about it, I'm like, this just feels so fragile. Like that's the word that I use to say this. But 4 consecutive buy signals pulling back to the middle of the trading band, but it just feels really fragile.
Well, at this point, it's not like we haven't seen something similar before.
Yeah.
Roll back 6 months at this point. I mean, if you're looking at the chart and right now, you saw consecutive buy signals coming off of that low in October through November and December. Got some consolidation through January and February to then sort of have that resumption that we're sort of currently in, where now we're testing support there at that 2020 level, hoping that it holds there and we see a potential reversal up. But again, it sort of seems like, to your point, it's like we've been teased by small caps
Right.
before.
Yeah. Yeah.
And it's sort of, at this point, we're hoping to see a hold of support here and then sort of some resumption of some upside potential, because it really would feel nice to, and I think just anecdotally for a lot of investors and just based on opinions that we hear, people are looking for more participation.
Yes.
I mean,
Yeah.
they're tired of talking about the same things over and over and over again.
I'm tired of it.
We understand.
Yeah,
for sure.
Yeah. But so I don't know. I mean, the other point in terms of TNX, right? So that 10-year Treasury yield index, we saw it move higher yesterday to 4.55% there. It's one box away now from testing its
Bears
negative
resistance
trend line.
on.
Yeah. And one thing great guy, one of the analysts, another one of the analysts, frequent member on the podcast there. But one thing Will mentioned to me, and it always sticks with me, is when was the last time you saw a very similar pattern, right? So I guess in this regard, when was the last time you saw a trend break, right, for TNX, right? That was back in May of 2023. We broke through that negative trend line there. That was followed by some pretty swift upside action for TNX, right? Topping out, in the later parts of 2023 there, where we got some kind of normalization or fall back into a negative trend. But kind of looking now, interestingly enough, if you see that negative trend line break, those kind of highs around 4.95 don't seem too far away.
Well, and I think just somewhat to your point in terms of watching directionally where the chart's moving. I mean, path of least resistance right now is higher for rates.
Yeah.
And I mean, that plays into the narrative or potential narrative that we may not see these rate cuts. I mean, we may see them stay at this level. Who knows to what end when the Fed decides to cut rates. Right now, there's sort of, I think it's been rolled to maybe it might happen in September. It was June for a while there.
Right.
Now it's looking like September after this recent meeting. But I mean, there's the potential, at least in my mind, that we got to prepare ourselves for just no cuts in 24. And at this point, we'll see.
Right.
But at this point, we're looking at a chart that, again, path of least resistance is higher. We're not really seeing any test of support here. It's maintained a lot of support there, and continue, at least at this point, month to month, we see economic data that sort of we're waiting with bated breath to then go, well, wait, it's good. Is it good news bad news now, or is bad news good news now? And we sort of keep flip-flopping around
this week, because you never know. It's week to week. There's a couple of points here I want to mention. Of course, we aren't naive. There is a lot more in play, especially from a rate perspective, than purely technicals, right? So there's, of course, the economic data. That's probably going to have, just being candid, a little bit more of an impact than per se the pure trend break, if you will. So just keep that in mind when you're looking at these charts. There's economic data in play. And then the second one is you and I think it's super easy to sit here and say that's a bad thing for rates to be a little bit longer. I think the market plays into that. You see when rate expectations go up, the market, domestic equity wise, kind of falls a little bit. But it is important to keep in mind that there's a whole different asset class out there, right? You have suddenly an opportunity cost of holding cash, if you will, with higher rates. So keep that in mind too. We come at it with the lens of, a domestic equity viewpoint as well, but higher rates outside, make holding cash a little bit more attractive than, when rates are low.
Yeah, well, and it's interesting that with sort of this recent narrative of potential higher for longer, inflation still being sticky, we've seen some of those physical assets, as we noted earlier, really have really a pretty darn good March, but in some cases, gold in particular, we've talked a little bit about this week in our report, has had a very nice start to April as well.
Yes, it has. And we also saw precious metals move up into the first place in Dolly, some pretty notable stuff over on the asset class group scores page in relation to their score. Gold just continues to, move higher. Another thing that has moved notably higher as well, I'm just throwing out a bunch of stuff at this point, but the VIX. So there's a little bit more fear. Gold also comes into play in that. When there's a little bit more fear, you start moving to gold, physical assets. So there's some interesting developments in play.
Right. Well, and to your point, a little more than just, as you said about rates earlier, it's a little more than just watching a trend or watching a price.
Right.
I mean, we need to take all the information in, but obviously our guide is going to be here in terms of the chart, but it's understanding all the information outside of it as well, what it may mean. So at this point, we've seen quite a bit of action through this week alone. And really, we've kind of briefly hit on just little high level points that we've covered for as far as this week. I don't know that we've got anything else at this point.
Just in time for earnings season, that's coming up. So
Yep, and that'll
like
begin well, yeah, I always find it funny whenever I think about earnings season and I'm like, oh, it'll begin in earnest here soon.
All right.
That was a terrible pun. People can take
yeah.
for what they will. Yeah, a lot of banks coming up tomorrow, and I mean, really next week is when we'll see earnings season kick off.
Right. Yeah. Some other ones just as a parting shot, because we don't want to go on too long for you. We might have already lost you, quite honestly. But Boeing just continues to fall. Of course, Delta, I know that's your sector, so you might have a comment on their earnings.
So, well, earnings were a little mixed. They sort of beat on top line, but then overall their guidance for 2024 was a little conservative comparatively to other airlines. But I mean, we saw some positive action, at least early yesterday as it reversed up, but it's kind of testing some long-term support there. So that's what we'll keep looking out for Delta.
Did they say they weren't bringing in as many Boeings or, 737s? What did they say?
I don't think there was any conversation about any particular planes for them. I'm sure they probably avoided it in some fashion,
yeah,
but
okay. Do you have anything else to cut on?
no, I think we're set with all the topics we can cover here.
Yeah, so we quickly dissolve into madness. Again, just a quick plug, if you've made it this far, down in the description is going to be that kind of weight of the evidence piece we referenced at the very beginning. Give it a look. Use that as a guide for where we start the second quarter at and how we've traveled so far in 2024. Otherwise, nothing else from us.
Yeah, stay tuned next week as we'll probably have a few things to talk about earnings wise.
Probably. All right. Have a good one.